Impala Company is a global manufacturer and distributor of agricultural, construction, and forestry equipment. It reported the following information in its annual report. And here we have some inventory accounts for this year and an inventory balance for last year. Impala Company also uses the LIFO inventory method, last in, first out. Our instructions are as follows. Part A. Compute Impala's inventory turnover ratio and days in inventory for the year. The inventory turnover ratio equals cost of goods sold divided by average inventory. It essentially means how many times did our inventory get sold throughout the year. To compute this, we'll look at the value of our cost of goods sold, as well as the inventory balances at the beginning and ending of this year. So 17,533 divided by 3,279 plus 3,652 divided by 2 to get the average gives us 17,533 divided by 3,465.5, or roughly 5.06. So Impala sold the value of their inventory approximately 5 times during the year. To determine days in inventory, we take the total number of days in a year and divide it by the inventory turnover ratio, or 365 divided by 5.06, which gives us approximately 72 days in inventory. In Part B, we want to compute Impala's current ratio using end-of-year data, and then again after adjusting for the LIFO reserve. The current ratio equals current assets divided by current liabilities. So for this equation, we'll pull our current assets and our current liabilities of 29,752 divided by 11,549, which gives us a current ratio of approximately 2.58 to 1. If we include our LIFO reserve, we'll calculate this by adding that to our current assets, 29,752 plus 1,543, divided by liabilities of 11,549, gives us a ratio of approximately 2.71 to 1. So for Part C, if we comment on how ignoring the LIFO reserve might affect the evaluation of the liquidity, we make a comparison from 2.58 to 2.71. So after adjusting for the reserve, liquidity actually increases, meaning that Impala Company would have more assets to cover their current liabilities.